Good morning. This is Bakes, Kevin Baker with Bakes Takes. Welcome to the podcast. This is for the week ending Sunday, August 2nd. Welcome, and I welcome especially my wonderful son, Jack. Welcome back.
Well, glad to be here, Dad. Thank you.
Got a lot to cover, and first off, Sue, it's my answer to Kramer. Instead of the FANG stocks, I want to invest in silver, uranium, and ESports. That's also my lovely wife's name, although I never call her Sue. Bond prices are still going down. I'm pounding this point home, and I found another chart that makes it even look better to me. And number 3, Chinese stocks and sugar. Next up, we'll see. So we get a lot to go to. This is a new segment, Mike. I've got a real live portfolio, small account, just a small amount of money. But I want to show that I'm doing this side by side with everybody else and keep my feet to the fire and not just say, hey, all my picks are great, all my picks are lousy. Here we are. So we have, we're up a little bit, and it's early. So it's been a month, and we're trailing the S&P by a bit, but our whole point is to make money. And so I'm going to keep putting this up here, and you tell me the good, the bad, and the ugly.
I like it.
All right? And I'd like to kick Dave Portnoy's ass. So we'll see how that goes. The first one is ESports. Now, that's the E in Sue. I didn't do this in order. I came up with the acronym after writing the show. But I can't believe I'm saying this, but video gaming and esports. I'm surprised that this showed up, but I'm going to follow my eye and follow some logic. The top 3 names are C Limited, NVIDIA, and Activision Blizzard. And I hate to bring this up, but one of the things that I thought of was if we don't have football this fall, are we going to be playing Madden?
Yes.
I think so. I think that's a great point. I just read I think it was an article published by PwC in June. It was kind of a white paper, and they said that by 2023 they expect revenues to grow to $1.8 billion in the space, which is just absurd. I mean, in 2018, I think it was like $400 million or something like that. So that 5-year growth is just insane.
And I felt sheepish about this because I'm 50 years old. And
sorry, I didn't catch that.
You're not going to catch it.
One more time?
Yeah. And I said, why are people watching other kids playing esports or video games? And then I listened to Gary Vaynerchuk the other day, and he goes, well, you watch golf. And it's the same damn thing. And so if you can't argue with the fact he likes esports so much that he invested in a team with the ownership of the Minnesota Vikings. I know Tony Robbins has an esports effort. I think The Rock does as well. And so, if the eyeballs are there, the eyeballs are there. Twitch explodes. So here we go. And wish us luck. We just bought it. And I'm fascinated by the whole space, and I'm running up a learning curve. SIL is next, the silver miners. The top 3 names here are Wheaton. I'm forgetting the second one, but Pan American is the third name in the portfolio. And Jack was asking in the car, why silver? And this gets a little bit wonky and complicated, but the bottom line is that the Fed is printing an incredible amount of money. That leads people to precious metals. There's obviously a tremendous amount of strife in Portland and Seattle and what have you, so people want to have safe assets. And silver's going to play catch up to gold, in my opinion. And in the case, I bought SIL versus the ETFs that trade or represent the bullion, the metal itself, because I want to have the leverage. I want to have ounces of production going up, the price going up, expenses staying relatively the same, and the bottom line expanding, and the multiple of the mining stocks going up. So that's the rationale. So far, it's working. And there's going to be other charts that I bring to the table, the silver-gold ratio and things like that I want to highlight. But this is what I have this week. Uranium, we've been talking about. I'm still amazed at the number of people who are on Twitter and elsewhere that are interested in uranium. This past week, Cameco on their earnings report talked about restarting their Cigar Lake mine. That surprised some, knocked Cameco down. But it seems like we're rebuilding on that, and this chart here shows the kind of things I like. It comes down into the base on relatively low volume and starts to increase on big volume, and I think that we have a 2 to 3 year play here, and I'm going to continue this. URNM is the North Shore Global Uranium ETF, and there's been a lot of incremental bullish news over the course of the week. Cameco apparently is in the spot market, buying uranium to fulfill their obligations to nuclear power plants. Kazatomprom is doing the same thing. And again, I think this is a pretty chart and a big long-term trend, and I'm fascinated by it. Next segment is Bakes Takes, the fan mail and calls and questions. Mike, we're continuing to grow. Jack, your good friend James from Pennsylvania came in. James played hoop with Jack, or Jack played hoop with James.
Probably more of the latter than the former. Yeah.
That's I caught myself. And great 3-point shooter, by the way. And he responded, and it's interesting. Some people come in over Twitter, some people come email. I don't care. Just bring me your feedback. Was struck by the fact he could not fathom 15% interest rates because he's 23 and it happened 40 years ago, so it's understandable. He also said that I recommended How to Make Money in Stocks, the Bill O'Neill book that I brought up several times, and was I a growth manager? Yes, that's what I cut my teeth as a growth manager, and I think I have the scars to prove it. I've been in 2 mutual funds, 2 institutional firms, 2 hedge funds, so I kind of know where the bodies are buried. And I still make mistakes, but I make new ones. What do you think about big volume gaps up is the next question he had in names like Chegg, Twilio, Advanced Micro Devices, Shopify, Pinterest. And he said, I'm curious to hear your thoughts. Thanks for all the great info from the show. So, Mike, thank you for making this possible and making us look better than we probably are.
I like that.
This is a great dovetail for a number of topics I want to cover. I don't normally talk about individual stocks, and part of my past as a growth manager plays into that. When we bought individual stocks, we got into the weeds. And we read the 10Ks, and we called the competitors and the customers and the suppliers, and we looked into the eyes of the CEO and CFO as much as we possibly could. And then we either built a model, or I like to take the high model on the street, the analyst on the sell side that had the highest model, and see if there were ways that I think the numbers should be going up. Because if you beat the high, you beat everybody. And stocks tend to like upward revisions, upside surprises. And so I've stayed away from individual names because I can't do that with more than a handful of names. In the case of, if you're investing in an active mutual fund, what we used to do was, okay, Bakes is the healthcare guy, he's the tech guy, Mike's the retail guy, and you said, okay, that percentage that's in the S&P 500 or the Russell 2000, make sure your stocks beat those stocks. And, it's a tough game, and it's gotten much, much tougher. And I'm finding that if I can pick big themes via ETFs, as long as I make money, I don't really care how I make money. I think I mentioned, Lebanese pork futures the other day. Whatever works. Whatever works.
It takes, right?
Sorry?
Whatever it takes, right?
Whatever it takes.
Yeah.
Whatever it takes.
Mike, you're great at retail, by the way.
Yes. Yeah, I always beat on mine.
Yeah, there you go. Okay, so I went through his particular names, and I was saying, okay, why do you pick these? They big gaps up on big volume, and I love volume, and I love gaps up. This is Chegg, which is they're breaking it more into online learning. I remember them as being you basically rented textbooks.
It's renting a textbooks. It's also I mean, to call a spade, high school and college kids who are struggling with their homework, a lot of times it has solutions on its website.
Innovative solutions?
Innovative solutions. So I'm just going to leave that there and let you guys
would never
do
do that, right?
Not even once.
Okay, there you go.
I value my education too much.
There you go. Thank you. Did you say keep a straight face with that?
Yeah.
So here's Chegg. I called it the Cinco de Mayo. May 5th was the earnings report. That's a beautiful breakout. If you can see that on the chart, that big blue line, upside surprise. A gap means that there's so much buying demand, it just skips through a number of different prices, and it went from 40 to 60 in a day, pretty much. And what I was struck by, the day before didn't really give any clues, so you didn't have any insiders that were, providing tells that this was going to be a big beat. It's a long, flat base. You see this, it goes back for, 9 months or so. And think of it as a launching pad. And that when you break into new highs on big volume, it tends to create momentum that lasts for a while. The last breakout that just happened, yes, it gapped up on big volume, but you see how it sort of grinds up from the lower left to the upper right. That isn't the kind of look that I want. I want to see stairs. I want to see a base, that lasts, the longer the better, and then you build up on that as the fundamentals unfold and it improves. So I questioned the last breakout. I would recommend playing with the house money, which we talked about last week, right, Mike? Where you don't have too many doubles in 3 months. That's pretty rare. And so I would take the original investment out and let the rest ride, and then wait for the sell discipline to kick in that I've talked about in the past. I'm happy to review James if you want me to at some point. The other thing is, this is at 77 times earnings, and I don't care how low the analyst numbers really might be and how conservative the guidance might be. 77 times earnings is expensive. And, so if they have a misstep, it is going to be very, very ugly. So that's my thought on Chegg. And this is why I like how interactive this is becoming, Mike and Jack. I'm listening to my podcast, and I just get this tweet from James, and it's the CEO of Chegg on the podcast.
Oh, wow.
And so I said, okay, here it is. And go to the show notes, please, and check out. He's a fascinating guy, has very strong opinions, and you can make your own determination. But I'm finding that you guys are putting me down different paths. I'm following them, and then I want to hear back from you, what you get out of these things that I find. I want to be the Reader's Digest of investing for 22-year-olds that study like crazy and don't use Chegg. Anyway, Twilio, it's the same sort of thing. Look at this explosion back May 7th, and that's a great upside surprise.
That gap is huge.
It's huge.
Just went straight up.
And that's probably a short getting squeezed.
Yeah.
We can go into what that means, but I mean, it's forced buying, saying I'm wrong on the short side. I got to get out. I'm going to buy it back in. Now, this is almost comical. The consensus estimate for this year is 18 cents. The stock is at $283. I don't even know if that equals 999 times earnings, because I don't think it goes up to 1,000. But it is just. It is a big, big number. It is an expensive stock. They might have a cure for COVID and cancer in the back room that I don't know about. That makes it worth that. But Advanced Micro Devices, James also mentioned, broke out July 22nd. And, it's the same kind of thing. Look how long this base is. Took off on 2.5 times volume. Broke through 61. It spent 5 months between 36 and 59, and then it goes from 61 to 85 in 2 weeks. And now it trades at 90 times. So my point being is that when I'm going through my 1,700 charts every month, I'm looking for these bases, and I'm looking for these breakouts. And I want to see the volume pick up prior to the breakout so I have clues that lead me to sue. So, but Advanced Micro Devices, wonderful company, great turnaround, fantastic competitor to Intel that's getting better. we're at 90 times, and it's hard to justify 90 times earnings, in my opinion. Shopify, I just wrote down 785 times. Great service, great story. You use it all the time, and you probably don't even know it when you buy Natalie's juices and all these other kinds of things. It sort of enables people to Amazon themselves to an extent. But it's 785 times earnings, and I don't know what's going to stop it, but something's going to stop it, and I don't want to be.
Just to be clear, so 785 times earnings means it's 785 times what the actual value of the stock really should be.
No, I'm glad you asked. It's the PE ratio, so it's price divided by earnings. The price is 1,080. I can't see the earnings number, but then you divide by the earnings number.
Okay. Probably less than $2 per share. It's probably $1 and $2 per share.
And then you get a 785 times multiple. If I brought that to an investment committee, they would punch me in the face, and they'd probably be right. Now, there's somebody at one of the esteemed Wall Street firms, I won't mention names, and they've got a model that suggests that if you discount the future cash flows to the present, it's worth more than 1,080. I question that,
sure.
But I don't fight the tape. I mean, I wouldn't short Shopify,
right? Because
they will the bulls of a stock like this with a cult will rip your face off, and so. I just say, if you have Shopify, I would do the same darn thing. Take your original money out, wait for the sell discipline. You're not going to get top tick, but you're not going to write it back down if heaven forbid, they miss an earnings number.
Right. Play with that house money, right?
I like that idea. I just think it makes sense. Pinterest is the same kind of thing. Here, and this is a good example, Mike. $34.91 is the price. The earnings number on 2021 next year, which no one knows what earnings are going to be next year. 18 cents, and the multiple is bananas. I didn't even calculate it because I just, it's bananas. But here's the same kind of story. It's 9 months under 27, consolidating the base, and then it goes to 34 in 3 days. That's what, this is when this gets fun, is when you find things like that where I prefer cheapness with change. Not just cheap, but cheapness with positive change, and that's what I spend all my time doing. And I think that's what I found in the SU ETFs. Another Bakes Takes, bonds are going down. I came across even a better chart than I had last week. This is 234 years of 10-year government yields. And I just use this because it is so damn striking. It is historically the lowest yields we have ever seen, the highest bond prices we have ever seen. And do you guys understand the inverse relationship?
I do to an extent. I would say, inverse kind of speaks for itself. Obviously, as interest rates rise, prices go down.
Did Chegg tell you that, or
Chegg did not tell me that? Chegg did not tell me that. But no, it makes sense that you'd be paying less for an interest rate that doesn't pay as much when rates change. So
that's pretty good. So the upside of bond prices is if 55 basis points goes to zero. Chairman Powell has said we're not going to negative rates. I'm going to take him at his word. So this is becoming asymptotic right now. We're getting close to zero.
Good word, asymptotic.
I took the SATs last week.
Look at you guys.
Yeah, I'm pretty excited.
Did you use Chegg for that?
Yeah. Funny kid. Who's buying breakfast? So I think that yields are very likely to retrace at least some of this last 40-year 15% move in interest rates. I just think that makes common sense. And not next week, given what's going on with the Fed now and COVID and what have you. But over the next 3, 5, 7 years, I think rates are going to go up, bond prices are coming down, and as a rule of thumb, each 1% increase in interest rates makes the bond price go down 10%. So now, my audience are these youngsters, and you don't own bonds, and you probably shouldn't own bonds. I think you should be in stocks. and I think hopefully, I guide you outside of the S&P index fund that ought to be the base. So anyway, this is, but I do want to point this out because, bonds do get a lot of coverage, and it's in many people's portfolios. I do have some older folks. It's 40% of the portfolio, give or take. I think that 40% is at great risk. I do. So
also, Dad, I know that the Fed Chair Powell said that he's not going to let interest rates go below zero. Your prediction, do you think he holds to that or no?
I think he'd have a really hard time in front of Congress and the American public if bond yields go below zero.
It's been so easy for him so far.
And we've also seen that it hasn't done much in Japan and Germany to help things.
True.
So I think that 50. If you're going to buy a car at 55 basis points, you're probably going to buy a car at zero or at 1.55%. So I think that this is getting crazy. This is another money supply chart. I put this up last week, but I had to kind of stare at it again. This is 30 years of data, and people can make this business really complicated. I like to simplify things, and I just look at this chart and I say every time the money supply rises, rates go up at least 250 basis points or 2.5%. I just look at the chart. That's what it does. And I don't care why. It does. And this money supply moonshot, we've never seen this before. We've never seen this kind of money printing. So bonds are virtually certain to decline by 25% if that 2.5% increase in interest rates happens. And again, this money supply blast off is about the most massive ever seen. So there we go. Gold is now 2,000 plus. And I think it's telling us something is wrong. And the dollar's at a 2-year low. And if gold is forecasting inflation in 3, 5, 7 years, bond prices are going down. Have I beaten this horse dead enough? Okay, there we go. Bake Steaks Reporters of the Week, as Jack will attest. I'm still going through the pile that you saw on Twitter. And I don't have anything right now because I went through the 1,700 charts. We have a lot to talk about. And I wanted to get to James' question. So I'll talk about the reporters that I want to highlight next week. Now these are the Bakes Take segment charts and tweets of the week. 2 out of the 1,700 charts, China's looking interesting to me. And again, I try to check my bias at the door. The controversies that Trump kicks up, President Trump, I'll be a bit more respectful. There's obviously anti-Chinese sentiment. It's an election year. Both sides of the aisle like to take their shots, but the stocks are going up. And then there's a podcast that I'll relay that I want you to check out that really changed my view on China, the stocks versus the people versus the Communist Party. And I think it's an important distinction.
How investable is China? Would you be buying ADRs or would you?
I would go through the ETFs because just because I want to be diversified. We're talking about relatively small amounts of money, and it goes to Bobby's question last week. My other son, God bless you. Building a diversified portfolio. For us to do it with relatively small amounts of money, it's very difficult. An ETF. This is going to be 30, 40 stocks spread over, I don't know how many billions of people in China. And so that's the way that I do it. Now, people could do do it however they want. I just like the idea of having a outside the U.S. presence and having it in a diversified way and a liquid way. If I'm wrong about any of these stocks, I can be out in an afternoon.
Makes sense.
So I'm having fun with this. This is the Tecurium Sugar Fund, and I wrote down pour some sugar on me, Def Leppard online too, because I'm juvenile. Sugar looks like it's perking up. I don't know why, but it's another commodity with uranium, with silver, with gold that is perking up, and I don't have a chart this week. But corn and wheat look like they want to go north, too. So something's going on with commodities. I think that does point to future inflation. I don't think it's going to be dramatic anytime soon, but I think down the road it's pretty likely. Okay, here's the one of the podcasts of the week. I've got two because these are really good. The Compound Show is by Josh Brown. He's the CEO of Ritholtz Wealth Management and talks about how to invest in TikTok, the opportunity in Chinese tech stocks. And I was introduced to a new fellow that I hadn't heard of before, Brendan Ahern, the Chief Investment Officer of Crane Shares. And he was pretty thoughtful about, he spends a lot of time on the ground in China, talked about, I was fascinated by, they knew he was an American when he reached for his wallet to go to a meeting in Shanghai to show his ID at the office building. No one in China uses a wallet. They put their phone up, and that's everything. The massive size and scale of Ant Financial, which is going public pretty soon, I think is fascinating. They are just a monstrous company that would be, I think, would dwarf J.P. Morgan. I don't know the exact numbers right now. But I really recommend the podcast. This is what I like to do. I like to be a hub, and then and give some kudos to Josh, who does some really good work. Brendan, who does some really great work. He has a daily morning note, ChinaLastNight.com, that I've signed up for. That I really want you to pay attention to this if you have an interest in China. If you don't, that's okay too. Anyway, this is another great podcast. This is Jason Calacanis. He is an angel investor in Silicon Valley, was one of the original Uber investors, Robinhood, Calm. I'm sure I'm missing several others. He's pretty prolific. And this is kind of cool. This is his all-in podcast. These are his poker buddies, Chamath Palihapitiya. I hope I'm getting that close. David Sachs and David Friedberg. Here are his poker buddies. Brilliant tech investors, brilliant people, in my opinion, and talked about the big tech antitrust hearings and what's going on with, like, Facebook can't buy anything. I mean, that, as a for instance, and that's a fascinating dynamic in Silicon Valley and elsewhere. And so I just recommend to give this a listen, see if it's your cup of tea, and I hope you enjoy it. Anyway, please subscribe, review, and share my Bakes Takes podcast on Apple, Spotify, or your preferred platform. Please also subscribe to my Bakes Takes YouTube channel. The audio is the same, but the charts that I reference are on the screen. Follow us on Twitter at BakesTakes_ and other social media. Please use your voice memo app. Tape your questions and email me at bakes@bakestakespodcast.com, or write if you prefer. I'll keep you anonymous if you'd like. Thank you for listening. Mike Wilson is my producer. Jack is my wonderful son. Thank you for joining me. Have a great week. And for much needed levity, this is Kyle Kinane, his most recent project, Trampoline in a Ditch. One of the funniest guys going, in my opinion, and I think we need levity in this crazy time. I'm Bakes. Have a great week. See you soon. Take care now. Bye-bye.